Hi, welcome back to Cheryl Trades Leaps. As you know, one of the biggest misconceptions in options trading is that the hardest part is choosing the right stock. Most traders spend their time studying charts, researching companies, and searching for the perfect entry point. They believe that if they pick the right company at the right time, the trade will naturally succeed. But experienced investors eventually learn a very different truth. The most difficult part of trading long-dated options, commonly known as LEAPS, is not entering the position. It is holding the position when the market becomes uncomfortable. 1. When the screen turns red. Imagine you purchase a LEAPS call option on a strong technology company. The business is growing, the long-term outlook is promising, and the trade initially works well. The stock rises, your option gains value, and the position begins showing strong unrealized profits. Then the market enters a correction. Over the course of a few weeks, volatility increases and technology stocks begin to decline. The stock you own falls 20 or 30%. The option that once showed large gains suddenly gives much of them back. Your screen turns red. At this moment, most investors begin asking themselves the same question: should I sell before this gets worse? This is the psychological moment where many long-term trades fail, not because the thesis was wrong, but because the volatility becomes emotionally difficult to endure. 2. Why market corrections feel so uncomfortable. Part of the reason corrections feel so stressful is biological. Human beings evolved in environments where sudden losses or danger required immediate action. When we experience financial losses, the brain activates a similar stress response. Fear signals encourage us to eliminate the source of discomfort as quickly as possible. In investing, that often translates into selling. The problem is that financial markets operate very differently from survival environments. Temporary losses are not always signs of danger. In many cases, they are simply part of the natural movement of markets. Yet the instinct to escape the discomfort can still feel overwhelming. 3. The paradox of growth stocks. Many of the greatest companies in the market have experienced multiple large corrections during their growth phases. Consider the history of Apple Inc. Over the past 2 decades, Apple experienced several drawdowns of 30% or more, even while the company continued building one of the most successful businesses in modern history. The same pattern has appeared in many other technology leaders, including companies like Nvidia and Microsoft. These companies eventually produced extraordinary long-term returns, but the path upward was far from smooth. Investors who sold during every correction often missed the majority of the long-term move. This creates an important paradox. The very volatility that causes investors to panic is often the same volatility that occurs inside powerful long-term trends. 4. Understanding the purpose of corrections. Market corrections are not unusual events. They are a structural part of how markets function. During corrections, several things typically happen at the same time. Liquidity tightens, volatility increases, and weaker investors exit their positions. Prices may temporarily fall faster than fundamentals change. To long-term investors, this process can feel chaotic. But in many cases, it serves an important purpose. It resets excessive optimism, reduces speculation, and clears the way for the next stage of growth. For investors who understand this process, corrections become easier to interpret. Instead of seeing them purely as failures, they can be viewed as temporary phases in a longer market cycle. 5. The challenge for LEAPS investors. For traders using LEAPS options, corrections can feel especially intense. Options amplify price movements, so a moderate decline in the underlying stock can produce a larger temporary drawdown in the option itself. Watching the value of an option fluctuate can test even experienced investors. This is why LEAPS trading requires not only a strong understanding of companies and markets, but also emotional discipline. The key question during volatility is not simply, why is the price falling? The more important question is whether the long-term thesis has changed. If the original investment idea remains intact, if the company continues to grow and the broader trend remains favorable, then a temporary correction may simply be part of the journey. 6. Anchoring conviction in structure. Professional investors often rely on structured frameworks to maintain discipline during difficult periods. For long-dated options, one useful anchor is the concept of delta, which measures how closely an option moves relative to the underlying stock. Deep-in-the-money LEAPS options tend to have higher delta, meaning their behavior resembles holding shares while still offering leverage. Understanding the structure of the position can help investors avoid reacting purely to short-term price movements. When volatility rises, the goal is not to eliminate emotion entirely, that is nearly impossible, but to prevent emotion from overriding the original strategy. 7. The discipline of patience. One of the least discussed skills in investing is the ability to remain patient when markets become uncomfortable. Financial media often emphasizes constant action, buying, selling, hedging, or repositioning. But many successful long-term investors know that sometimes the most disciplined decision is simply to allow time to work. For LEAPS investors, time is an important asset. Long-dated options are designed to capture extended trends, not short bursts of momentum. Reacting too quickly to temporary volatility can undermine the very advantage those options provide. 8. The real test of conviction. At some point, every investor experiences a moment when the market tests their conviction. Prices fall, uncertainty increases, and fear spreads across financial headlines. The temptation to exit becomes stronger with each passing day. Yet these moments often reveal the deeper reality of long-term investing. The path to meaningful returns is rarely comfortable. Volatility, doubt, and temporary drawdowns are not exceptions to the process. They are part of it. For investors who understand this, holding through difficult periods becomes less about stubbornness and more about discipline, because in many cases, the difference between an ordinary trade and an extraordinary one is simply the ability to endure the volatility required to reach the destination. Thank you for watching, and see you soon in the next video.